Welcome to Yahoo Finance's flagship show, Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures are pushing higher after equities closed out a third day of gains. The S&P 500 is now trading above its 50-day moving average, a sign of technical support for stocks. And despite concerns over valuations and the Federal Reserve's path forward, Wall Street remains bullish on the stock market. Deutsche Bank, Société Générale, and JPMorgan all boosting their 2026 targets for the benchmark index. JPMorgan also sees the benchmark potentially reaching 8,000 should the Fed easing continue. Plus, HP and Dell are out with earnings. HP sinking after its profit forecast fell short of estimates. The company also announced it plans to cut up to 6,000 jobs by using more AI tools. Those cuts will result in gross savings of $1 billion annually. Meanwhile, Dell is gaining today on its outlook for AI server shipments. The company did slightly miss on revenue estimates for the third quarter, but Wall Street appears to be focused on the company's AI momentum. And speaking of artificial intelligence, Nvidia shares recouping some of Tuesday's losses. Nvidia fell after reports the company's losing ground to competitors like Alphabet. The stock is now down 14% since the start of the month, erasing more than $700 billion in market value. Meanwhile, famed short seller Jim Chanos is raising concerns about Nvidia regarding circular financing. He told Yahoo Finance the chip giant is putting cash into money-losing companies in order for those businesses to order their chips. Let's get a check-in on stock futures. We do have a little bit of perking up here this morning. We'll see if it lasts. Remember, it's the holiday shortened trading week. We tend to have lower volume on days going into a holiday. But with all of that said, the Nasdaq futures pointing to a gain of about 0.4%. S&P futures a little more than half that, as are Dow futures. So a little bit of green across the screen. So let's dig into our top stories of the day. Stocks edging higher after the Dow notched its third straight winning session. Nvidia facing growing doubts over its AI dominance, plus the biggest takeaways from Dell and HP earnings. Joining me now, markets and data editor Jared Blickery, senior markets reporter Ines Ferré, and tech editor Dan Howley. Jared, we're going to start with you. As I mentioned, we talked a lot about the 50-day moving average recently. We went below it. Now we're a little bit above it. The AI trade is still sort of like a day-by-day phenomenon here. So what's the setup look like given all that this morning?
Yes, we're seeing a lot of strength, not only in the big guys, and Alphabet is one of those, we can talk about that in a minute, but also the smaller stocks. And here's a look around the world real quickly. You already went through the majors and their futures. Just want to point out that the Russell 2000 looking a little bit negative right now, whereas around the world, things are pretty green. And I'm focusing on the Russell because that is where we have seen the most strength over the last 3 days amid this three-day rally. Here's the NASDAQ. That is up 4% over these 3 days. You see that right there. Here's the Russell 2000, up almost 7%. S&P 600, another look at small caps, except they have to be profitable. That's up over 7%. So the backdrop has been pretty strong. Nevertheless, taking a look at the sector action, you can see yesterday healthcare was the number one performer. And Julie, I know you've had your eye on healthcare. This is over the last 3 days. It's in the number 2 position, up 5%. And then since the beginning of the fourth quarter, since October 1st, is by far and away the biggest and best performer there. You can see it's up 14%. Utilities in second place, up only 2%. And that's just barely edging out the S&P 500, which is barely positive. Everything else in the red there. So it's really been kind of surprising. But this is what we talk about in a bull market. Sector rotation is the lifeblood of the markets. When a lot of the leaders in the market, AI leaders were going down and Nvidia was down yesterday, we've seen other sectors and other stocks step up.
Yeah, I mean, it's been pretty amazing, Jared, to see that healthcare move because it's been kind of a sleeper move, right? All of us are paying attention and the market, the talk, most of it is around AI and big tech. And here comes healthcare sort of like stealthily moving into that top position for the quarter and the month. But let's get back to those big tech stocks that we watch so often.
Yes, we got to get to them.
We got to get to them because the Alphabet Nvidia divergence really has been an interesting story. And even though it's sort of burst into the fore over the past couple of days, it's been happening really, it's been building over the past month or so.
Yes, and let's go back to the Wi-Fi Interactive here, where I do have Nvidia versus Alphabet, and this is a year-to-date chart, and what you can see is their fortunes were pretty tied together. Here's that post-Liberation Day April low, and then we went up, and then Nvidia really started going sideways after July, and it made a little spike, but it came down here. What you really see, where you really see the divergence is in the last few weeks, and if you start this chart at the beginning of that April bottom, you really see the outperformance of Alphabet. It's up 123% since then. Nvidia up 85%. I think investors should be ecstatic about that. That's all in great. But there's another divergence I just want to point to, and that is that NASDAQ 100. So some of the biggest stocks in the NASDAQ versus Bitcoin. And here we go again, versus that April low. The Qs, as they call them, that's the NASDAQ 100, is up 46%. But Bitcoin really started selling off earlier than everything else in October, and it's been kind of a risk barometer for me. It just hasn't been able to really accelerate on the days when the general market has. So I'm keeping a close eye on that divergence as well, Julie.
And it looks like Nvidia is keeping a close eye on that divergence too, which is maybe a little bit unusual here. Dan Halley, yesterday, I thought it was pretty remarkable to have Nvidia tweeting, "Hey, good for you, Google. Good for you that you're getting traction here for your TPUs and getting that reportedly getting that Meta contract." I mean, what did you make of that, and what do you make of this kind of like split that we're seeing in the stocks?
Yeah, I thought that was interesting. I thought the note that they had sent out to analysts was interesting. Basically, trying to cut into all the arguments against Nvidia itself, whether that was the circular investing or accusations that it's an Enron or WorldCom or something along those lines. Basically, shooting all of those down. Talking about the depreciation of some of their chips, and Michael Burry basically saying that Meta and Oracle and says others, but hasn't mentioned what other companies, but that they're extending the lifetime of their chips, and so they're artificially inflating their revenue. And Nvidia said, even during their most recent earnings call, that look, their chips can last quite a long time, and so some companies are still using their A100 chips, and just that those are very old chips, when you consider how fast these things move. And so, it was interesting to see Nvidia come out and say, look, as he basically said, good for you, Google, pat on the back. Our stuff's still better. This is this conversation that has been going on. And if, I've been to a number of Nvidia conferences, sat in, a number of rooms with Jensen, and, he's regularly asked about these ASICs, or, what Nvidia calls its tensor processing unit, excuse me. They're a form of ASIC. It's a application-specific integrated circuit. And so basically it's a chip that can run these AI applications, but it's not as general purpose as something that NVIDIA has. And so the trade-off there being that because they're application-specific, they can be more efficient. NVIDIA basically says, look, our stuff is still better, it's still faster, and we're getting more efficient as time goes on. And so, it's going to be this, I think, this continued back and forth. It could be a function of NVIDIA just controlling so much of the market when it comes to these chips, that the kind of, it brings in the worry of, well, are they really that good? Are they not? But again, I think, we've spoken about this before, about how, sure, their customers have been doing this for a while. This is not new that Google has its TPUs. It's not new that Meta is working on its own chips, Microsoft, Amazon. This has all been happening for years at this point.
Well, I mean, so there's that concern, but there's also this sort of background concern that's been going on, that those short sellers like Jim Chanos, Michael Burry, who now has a newsletter, have been highlighting, which it's not just about the competition, it's about this over-investment, right? And that was reflected in the Bank of America latest fund manager survey, where the majority of folks there said, yes, these companies, or an uptick of folks said that companies were over-investing, right? And so a record number, excuse me, and then you have Jim Chanos telling Yahoo Finance that Nvidia is putting money into money-losing companies in order for those companies to order those chips, Dan. So this is, the bubble, the dot-com bubble comparisons, all of that, it doesn't seem to be going away.
No, it certainly doesn't. And, I think, CoreWeave being one of those companies that a lot of people point to when it comes to companies that Nvidia invests in that still aren't making money, or it'll take them a while to make money. Nvidia says, look, we're not the main holder of these companies, right? We're investor in them. They're on their way to profitability at some point. That's basically what they're saying in their note. As far as the build out, I mean, look, Mark Zuckerberg himself during Meta's earnings call said, hey, we may be overbuilding, but we'll get to using that eventually, kind of shrugging off those concerns, which was actually quite stunning to hear when this conversation has been going on in the background of overspending, and if these companies are going to be able to monetize anytime soon with regards to these huge expenditures. They're accounting when it comes to that huge data center that they're building that's a portion of the size of Manhattan.
Right.
And so there's a lot of questions about, when do these companies then start to recoup all of this investment? I mean, we're talking hundreds and hundreds of billions of dollars at this point. And so far, Meta's gotten a pat on the back for monetizing when it comes to its advertising, when it comes to building into its own, Meta AI capabilities. OpenAI has, done relatively well, though they're not on track to make money. I think around 2030 is when the break-even point would happen for them. Anthropic 2028, according to the most recent reports. But these other companies, the Microsofts, the Googles, the Metas, the argument has been they already are financially sound. They're just pouring a lot of cash in. But I think a lot of people are starting to question, okay, so you have to start making money on that cash, though.
Okay, so when we talk about all of this return on investment, here you have a company in the form of HP coming out today saying that they are cutting costs, and part of that has to do with the theme you've been following, Dan, about memory chip prices going up and costs going up. But it also, Ines, has to do with just them using more AI, it sounds like.
That's right. Using AI tools for greater productivity and really integrating those AI tools. And HP's Enrique Lores spoke with Brian Sozzi yesterday and was talking about that initiative, this big cost-cutting initiative that they have, and these AI tools that are going from pilot to initiative phase, where they are basically wanting to save $1 billion over the next 3 years, and also announcing that this will mean a cut of 4,000 to 6,000 jobs globally. So there you have sort of a number that's out there for what this means as far as job cuts. And this is interesting because we know that AI is transforming the way companies operate, the way they work. But really, what I think investors have wanted to see is what this will also mean for the job market as well. And even when you had the Challenger report coming out earlier this month, it talked about companies citing AI. It was the second most reason that was cited for job cuts, and that's because they're automating, because they are more productive. And here you see this case where HP is basically saying, yes, we're using more AI tools, and yes, we're going. There will be this cost-cutting measure will result in as much as 6,000 job cuts.
Okay, so that feels pretty dire, sounds pretty dire. We have all these overinvestment concerns. We have all this volatility recently in big tech. And yet, Ines, we're starting to get those 2026 forecasts from Wall Street, and they're feeling pretty bullish.
Very bullish. If you take a look at, those are some of the banks that have put their price targets out. JPMorgan just put out the 7,500 for year-end for 2026 for the S&P 500 in their global equity outlook. But they're saying that it could actually surpass 8,000 in 2026 if the Fed eases policy further. So the basis case here is that the Fed will be cutting, that you have strong earnings, and that you also have this AI growth story that will underpin the rally going into 2026. And this is what Wall Street firms have been saying. But if the Fed were to cut more aggressively, if it were to cut more, then you could see 8,000 in the S&P 500. And this jives with what some of the banks have been, some other firms have also put out there. You have UBS that also they have a 7,700 price target for the end of the year. But I think a lot will be riding on How much will the Fed cut? And also one other note that JPMorgan noted also, earnings benefits tied to deregulation, that is underappreciated, and AI-related productivity, there it is again, that is also going to underpin some of this earnings growth.
Whew, a lot fit in there, guys, and a lot to watch, even on this short holiday week. Happy Thanksgiving to everyone. Thank you. Coming up on Morning Brief, we'll bring you today's top trending tickers and count you down to the opening bell. We'll be right back. Now time for some of today's trending tickers. We are watching Deere, Urban Outfitters, and Autodesk. First up, Deere. The farm equipment maker's profit outlook for 2026 fell short of expectations. Those numbers come as uncertainty lingers around the recovery for U.S. farmers who have been hit hard by low crop prices and President Trump's trade war. Now, despite the recent U.S.-China trade truce, there are still questions on whether that will be enough to revive the farm economy. Deere estimated 2026 sales for its large agricultural segment to be down 15 to 20%. In the U.S. and Canada, the shares are down almost 4%. Next, Urban Outfitters. The retailer reported net sales for the third quarter that beat the average analyst estimate. The stock's actually headed for a record high as shoppers snap up the company's full-priced clothing. Urban Outfitters runs its namesake brand and also, remember, owns Anthropologie and Free People. Analysts note that Urban Outfitters' expanding brand portfolio supports further sales upside and helps explain its margin strength. And finally, Autodesk. The software company boosted its adjusted earnings per share guidance for the full year. Deutsche Bank also upgraded its rating on the stock to buy from hold. The results were boosted by steady subscription renewals and growing demand for its cloud-based design tools. Shares are up a little more than 7%. Well, worries about the AI trade are among several factors that have given bears on Wall Street plenty of time in the spotlight as of late. But some strategists suggest the bears could exit stage left in 2026, and they've put bullish S&P 500 calls on the table. Joining us now, Matt Stuckey, Northwestern Mutual Wealth Management Chief Portfolio Manager of Equities. Good to see you, Matt. So we're starting to get these sort of Wall Street 2026 forecasts, and most of them are pretty bullish here, not wildly, but reasonably, I guess. And a lot of them are talking about AI as one of the reasons behind that. So how are you thinking about kind of the setup for 2026 at this point?
Look, I think if we're contemplating the next 12 months and kind of what's been moving in markets and kind of how we expect that to change in 2026, we do see the potential for the markets and the economy to broaden out next year, and that's a good thing if you're an investor. What's really driving that is we've been in the last 2.5 years of fairly of a narrow economy and a result narrow markets as the Fed has raised rates. That's constrained things like manufacturing and housing, and really the strength of growth has been in companies related to the ongoing kind of build out of artificial intelligence compute capacity. We think that probably continues in next year. Companies are going to continue to spend on AI, but we think that there's also the opportunity for things like housing and manufacturing, more parts of the economy to start to improve next year. And with that, I think comes broader market participation in terms of strength in the coming 12 months.
What do you think is going to catalyze that broadening? Because people have been hoping for broadening for a long time that hasn't quite materialized. Is it just the Fed cutting rates?
Well, I think we actually have been seeing it the last 4 or 5 months. And what I'm watching in terms of the sustainability and ultimately whether or not that comes true is earnings revisions. And what you're seeing is for the first time in the last few years, there's been some sustained earnings revision strength in things like U.S. small caps and U.S. mid caps. It's not just the Mag 7 driving earnings higher. It's more and more segments of the economy and the markets also showing some strength in terms of fundamental upside. And so, in fact, if you're looking at some of the strongest kind of next 12-month earnings growth revision trends, it's come from small cap. It hasn't come from large cap, even though it continues to be strong as well. And so I think that needs to sustain throughout the fourth quarter and into the first quarter of 2026. And those expectations for earnings growth need to be followed with actual earnings growth in terms of what's reported. And so that, to me, is the major catalyst on a sustained rotation, a sustained broadening out in terms of markets.
Matt, I'm curious about the backdrop here for labor and sentiment. You know, we got a consumer confidence number yesterday from the Conference Board that was pretty lousy. We continue to see companies like HP, for example, coming out today saying they're going to be cutting jobs. So how do you think about sort of spending related to confidence, et cetera, as we go into next year?
Look, I think the pessimism towards the labor market's fairly well understood by the market right now. You highlighted some of the confidence surveys. I think the one that really stands out to me the most is the University of Michigan Consumer Confidence Survey. The percentage of respondents expecting employment to be higher over the next year hit 71. That's the highest number that we've seen since 1980. And so consumers are more anxious about the labor markets. But on the other hand, labor market softness, albeit not outright weakness, is what's allowing the Fed to continue to cut rates and allowing things like housing and manufacturing to come back a little bit. And so it's a delicate situation. And to me, I think one comforting kind of anecdote that I would throw into that equation is the fact that we are seeing, like we just talked about, more broader earnings growth. And over the longer term, what we have seen throughout history is that earnings growth and employment are correlated with one another. Companies don't hire in tougher earnings environments, but they do tend to expand when earnings are growing, and earnings are growing across the economy at a more rapid pace.
Matt, all of this said, it seems to me, just judging from your notes and what you've talked about, that it's not necessarily it's an or, it's an and in terms of whether investors want to own the other stuff. It's not or AI, it's and AI, correct?
Yeah, that's how we're thinking about it. Diversification is the way you navigate these types of market environments where things might be changing in the background. Monetary policy getting more easy, ongoing kind of fiscal tailwinds in terms of the one big beautiful bill that start to pay out in 2026. And so there could be changing dynamics versus the narrow economy and the narrow markets that we've seen since 2022. And so we're talking to clients about kind of embracing that in portfolio construction, making sure that you have exposures to not only the Mag 7, but things like U.S. small cap and mid cap, which we think have lower expectations in terms of their valuations and are starting to inflect higher in terms of earnings growth.
Matt, good to see you. Thanks so much. Well, coming up on Yahoo Finance's opening bid, executive editor Brian Sozzi is with us now. Soz, what are you watching today?
Hey, Julie.
Giving turkey tips today?
Yeah, don't overcook your turkey, all right, and baste it accordingly. Okay. I mean, what do I know? I'm smoking a brisket that I spent $100 on. I got that post on LinkedIn. People, check it out. But I'm going to have some more on my conversation with HP CEO Enrique Lores. Julie, I was blown away to sit there and do this interview and hear how AI is taking lots of jobs at an iconic company like HP. I mean, absolutely blown away. Also, our friend Dan Ives in the house. He's here for Power Player. We're looking at his top tech stocks.
Let me guess, he's wearing all black like you.
He's wearing all green. He actually looks like an F1 driver right now, Julie.
Okay. Yep. I got to go find him in the office.
He's right out the door, Julie.
That does it for Morning Brief. Much more ahead on Yahoo Finance. And watch, Dan Ives looks like an F1 driver.